Welcome to this exam prep explainer. If you're gearing up for your insurance fundamentals exam, you already know chapters 3, 4, and 5 are, well, they're basically a dense maze of statutes and legal conditions designed to trip you up, right? It kind of feels like reading a foreign language sometimes. But today, we're going to break it all down step by step so you can walk into that exam room with absolute confidence.
Okay, I'm going to hit you with one of the toughest exam questions right out of the gate. What is the exact legal difference between a friendly fire and a hostile fire? I know, it sounds like a trick question, maybe even a bit poetic, but trust me, the distinction is absolute and it is highly testable. By the end of this explainer, you'll know exactly how to conquer it, along with the core concepts that dictate how insurance truly operates. So, keep that question in the back of your mind.
All right, here is our roadmap. We're going to cover government rules, statutory conditions, the three key players, property policy fundamentals, and finally, calculating payouts. Let's get right into it.
Section 1. Government Rules and Regulations. We're looking at the strict statutes that govern how companies and brokers handle money and consumer trust.
So take the term fiduciary. This is a huge, highly testable vocabulary word, and it basically means brokers and insurers hold collected premiums in trust until a policy expires. It's kind of like holding onto a friend's wallet, you know? You have their money, but it is definitely not yours to spend. Insurance is inherently fiduciary. When a client pays a 12-month premium up front, the insurer hasn't actually earned all that money on day one. They earn it day by day. If the policy gets canceled after just 1 month, the unearned portion, those remaining 11 months, literally has to be refunded. That's the absolute essence of a fiduciary duty, meticulously safeguarding other people's money.
Next up is subrogation. This literally means stepping directly into the insured shoes. Basically, once an insurer pays a claim, they legally acquire the right to sue the at-fault party using the insured's name to recover those funds. Let's say a careless neighbor accidentally burns down your fence. Your insurance company pays you to replace it, right? But insurance companies aren't exactly in the business of letting guilty parties off the hook. Subrogation gives your insurer the legal right to march over to that neighbor, step into your shoes, and demand their money back. You will absolutely see this on your exam, for sure, so lock it in.
Moving on to Section 2, the statutory conditions. These are the standardized, legally binding rules printed on every single fire insurance policy.
Now, while all 15 conditions matter, test writers are honestly obsessed with a few specific areas. You've got to know what happens if someone lies on an application. That's misrepresentation. You need to understand the fallout of fraud during a claim, and of course, the rules of appraisal for when the two sides just can't agree on a payout. But let's zoom in on material change, because that is a classic, heavily tested trap for students.
Pay close attention to the exact legal phrasing here. A material change must be substantial and continuing. Imagine the Butler's Furniture Store decides to start hosting daily indoor barbecues for their customers, right? That substantial, continuing change drastically increases the risk. Now, a one-day outdoor barbecue event, not a material change, but setting up a permanent, daily indoor grilling station surrounded by highly flammable couches, no way. That massively introduces a brand new, ununderwritten fire hazard. Because it's a continuing change within their control, if they don't report it, the insurer can and absolutely will deny a related claim.
Let's pause for an active recall checkpoint. This one is pulled straight from your text's self-examination questions. Imagine an insurer decides to terminate a policy. They can't just cancel it instantly and leave the client unprotected, right? They have to provide specific, standardized notice. Do you remember the exact timeline required if they send that termination via registered mail?
All right, if you said 15 days for registered mail or 5 days for personal delivery, you are spot on. This numbers game is a huge favorite for test writers. A good way to remember it? Snail mail takes longer, so it's 15 days for registered mail, and that counting starts the day after the letter arrives at the local post office. Or it's a swift 5 days if the written notice is personally delivered right into their hands.
Okay, Section 3, the three key players. Here we map out the people who actually enforce all these regulations out in the real world.
In the insurance ecosystem, the rule of three works perfectly. First, you have the broker, whose primary legal duty is owed to the client. Brokers are often called first-line underwriters because they're the ones sitting across the desk, face-to-face with the client. Second is the underwriter at the insurance company. Their whole job is to protect the insurer's bottom line by deciding whether to accept, reject, or modify the risk. And third, the adjuster. When the worst actually happens, the adjuster steps in to investigate the facts and settle the loss fairly.
Now, underwriters are essentially hazard hunters, but they have to distinguish between what they can easily see and hidden dangers. Physical hazards are totally observable, things like frayed electrical wires, no fire extinguishers, or oily rags piled in a corner. Moral hazards, though, those are subjective and way harder to detect. We're talking about financial desperation or poor character. Think about it, a guy whose business is failing terribly, who secretly hopes his warehouse catches fire just to get a payout. That indifferent or even malicious attitude toward loss is a massive moral hazard, and the underwriter literally has to sniff it out before issuing a policy.
Section 4. Property Policy Fundamentals. Let's see how these rules apply to the physical assets themselves.
Let's clarify direct damage. Standard policies only cover direct physical loss. So if a fire cuts power and spoils a freezer full of meat at the Drew Drop By grocery store, well, that spoiled meat is an indirect loss. The fire directly burned the utility pole outside. That's the direct damage. The resulting lack of refrigeration causing the inventory loss, that's indirect or consequential. Because standard property policies only cover direct damage, unless the store bought a very specific endorsement for indirect losses, they are unfortunately completely out of luck.
Now consider the danger of a warranty. Think of a warranty as an absolute, unyielding guarantee. Exact compliance is 100% mandatory. There's this classic example in the source material about a welder named B. Iron. He had a warranty on his policy strictly prohibiting spray painting in his shop. Well, he ignored it. Sometime later, a massive fire breaks out, and here's the crazy part. The fire was caused by welding sparks, not the painting. But because he breached the warranty, that exact promise, the entire contract was completely nullified. His claim was denied, plain and simple. It's a harsh reality, and definitely a tricky legal loophole you need to watch out for on test day.
Finally, Section 5. Calculating claims and payouts. This is where we put on our adjuster hats and do the actual math.
All right, get your notepads out. Here is your 3-step formula for determining indemnity. 1. Calculate the actual cash value of the damaged property. 2. Establish the financial interest of the insured. And 3. Check the policy limit. The golden rule for the adjuster is to compare these 3 numbers and always pay the lowest amount. Let's say a store's shed burns down. The actual cash value is $1,200. The owner has 100% interest, so that's also $1,200. But the policy limit is only $1,000. Because the adjuster has to pay the least of these 3 figures, the final payout is capped at exactly $1,000.
The difference between actual cash value and replacement costs is an absolute exam favorite. Actual cash value, or ACV, subtracts depreciation for wear and tear. It ensures you don't actually profit from a loss. If your 20-year-old roof gets destroyed, ACV pays the value of a 20-year-old roof, not a brand new one. Replacement costs, on the other hand, ignores depreciation and pays for new items, but it comes with some strict strings attached to prevent fraud. If your commercial business burns down, you can't just take a massive replacement cost payout in cash and move your business to the Yukon. You have to act diligently and rebuild on the exact same or adjacent site.
Let's trigger one last active recall checkpoint to see if you've got a handle on the standard mortgage clause. Imagine a crazy scenario where a struggling store owner deliberately sets fire to their own business. It's clear arson, it's fraud, and the owner's claim is rightfully denied. But what about the bank that holds the mortgage on that property? Do they just lose all their money because of the owner's crime?
The answer is yes. They absolutely still receive a payout. The standard mortgage clause acts like an invisible shield for the bank. The bank has a separate protected legal interest in the property. As long as the bank wasn't secretly aware of the fraud or any increased hazard beforehand, their financial interest is completely protected from the insurer's bad acts. The insurer pays the bank, and then they'll likely use our old friend, subrogation, to go after the arsonist.
Bringing it all the way back to our opening hook. A friendly fire stays exactly in its proper receptacle, but a hostile fire escapes. And you have to remember, only hostile fires are covered. If you accidentally throw your extremely expensive watch into a roaring fireplace, well, that fire is exactly where it's supposed to be. It's a friendly fire, so your burnt watch is not covered. But if a spark flies out of that fireplace and ignites your expensive living room rug, it has escaped its receptacle. It's now a hostile fire, and the resulting damage to your rug is fully covered.
So as we wrap up this explainer and you head toward your exam, ask yourself one big picture question. Will you be the broker who catches the moral hazard or the underwriter who prices the physical one? The statutes, the conditions, the math we've covered today, they aren't just hurdles designed to make your test difficult. They are literally the essential foundation of trust in the entire insurance industry. Keep this roadmap fresh in your mind, trust your preparation, and go ace that exam.